Alright, welcome everyone back again to the Education Diary Day number one based on the finance in the IT industry. So today we are going to be discussing about some of the cool things, some cool concepts in finance. I do know that the coding is or the IT background is really important. But of course, if you're going to be proceeding forward, you're going to be working in the companies or organizations, you might going to be working in the finance department as well. In the finance department, you should be having some at least some of the very basic knowledge in order to give the company more profit, or we can say having some more leads to the company or an organization so that they can gain more and more profit by the time, right? So we are going to be having some really great concepts today. We are going to be working some numerical questions as well, but once again we are going to be discussing each and every topic with some of the very basic details so that you can understand that how the finance department in an organization actually works. Now of course, if you're coming from a commerce background, if you're coming from an arts background, so you might have heard about all these things. If you're really good in mathematics, you can easily solve the questions. Now again, the questions are not going to be very hard to solve. The questions are going to be very easy, straight to the point, having all of the values so we can simply find out the answer, right? But again, if you're coming from a commerce background, so it's going to be easy for you to understand. You might have heard about all these things, but again, if you're coming from an IT background, you might need to know all these things, because as usual you may work in the finance department in future so that the company can generate more and more profit, right? Of course, you can be a finance engineer or a finance manager in the IT department. All right, so first of all, we are going to be reading all of the we can say definitions. So the IT industry thrives on innovations and technology. Understanding finance is critical, right? So it's really critical. Financial concepts like WAC help IT companies make informed decisions about investments and funding. Now, the full form of WAG is going to be weighted average cost of capital, right? Again, WAG is one of a really great concept in an organization in IT industry to make the company more profitable. Now, inside WAG, we are going to be having some more sub concepts like we can say cost of equity or cost of debt, return on investment, which is ROI, and some really we can say cool concepts, right? So we will be checking out each and everything so that you are going to be having an idea. All right, apart from that, you can see that this is the WAC. Now WAC is basically a crucial metric for IT companies as it represents the average cost of raising a capital. It considers the cost of debt and equity weighted by their respective proportions in the company's capital structure. The WAC is basically dependent on the debt financing as well as equity financing. Now, whenever you are working in a company, you're going to be working in the two categories, that can be a debt financing or an equity financing. Debt financing is kind of like a loan. You take a loan from a bank, and if you're unable to pay to the bank, so the bank is going to take over of your organization. But again, the debt financing do include some kind of interest. So after some time, you have to pay some interest, right? So based on the loan which you have taken, so you can say that that is basically known as debt financing. Now the equity financing is one of safe side of an organization in which you can that give some kind of portion of your company to the people, and you can just borrow the money from them, right? Now, as usual, you can see that equity financing involves selling ownership shares. So as usual, you are selling your own ownership shares to the company or to the stakeholders, right? So who are going to be giving you some kind of money, you are going to borrow the money from them, and you are going to give some part of your company to them. That is basically known as the equity, or we can say simply giving up your company shares to the people, right? Now here, as you can see, the equity is the market value of equity. Now equity can be divided into two different categories, that is the public companies and the private companies. Now again, private company stakeholders basically do get equity, but that is something private, that is not openly available on the stock listing. That means you cannot purchase the shares of that company, or you cannot basically purchase the own shares of that company if that company is a private company. But again, if you are going to be having some public companies which are publicly available, so you can basically go and you can check out, you can just purchase some of the shares, and again you are going to be lending, you are going to be giving some money, and in return you are going to be getting some percentage of the company's ownership, right? So that is in the case of the public companies. But for the private companies, it's basically hard. The stakeholders are basically the persons whom the owner actually trust, and basically they can give their ownership to those particular trustworthy people. All right, So now we are going to be having debt. So as usual, market value of debt. So again, if you are going to be lending money from different, we can say stakeholders or different people, you are going to be having two kind of different sections that can be in the form of bonds, that can be in the form of loans. So bonds are basically debt securities issued by the companies in order to raise the capital. They typically have a fixed interest rate and a maturity date. So as usual, you are going to be having some bonds. You can purchase a bond which is going to be having fixed rate. So suppose there is a middle person, or suppose if I purchase a bond from a company, right, and suppose if I want to sell that bond, then I can basically sell my name bond to someone else, right? So that person is going to be becoming the owner of that bond, and he is going to pay the interest rate to the company. So as usual, bond is same like loan, but you can actually sell the bonds to the other people, and you can simply we can say exit out from that particular transaction process, right? Loan is again based on the debt instruments which is provided by the banks. It is not being lended by an individual in the same case like bonds can be lended by the individuals, but loans cannot be lended by the individuals. These are basically being issued by the banks or the financial institutions, right? Apart from that, as I told you that in the VAC, we are going to be having some cost of equity. Now the equity, again, if you know about equity, you can understand that what is going to be the cost of equity. So equity is, again, we can say that a part of the company, a part of the ownership, or the part of some shares from that ownership of a company, and the cost of all these things is ultimately known as the cost of equity. Now it is going to be having some risk free rate, so that means it's not going to be having some negative. So suppose if there is a loss in a company, so there is not going to be loss in your cost of equity. So that is basically a risk free rate. That means there is no loss in your particular portion. Market risk premium, which is also known as MRP, the additional return investors expect from investing in the stock market compared to the risk free investments. Now this is basically a kind of like risky, but a risk-free rate is the much more better solution if you're looking to not make a loss in your cost of equity. Now beta is basically a measure of a company's volatility relative to the overall market. So as usual, suppose if the fluctuations are there in the market, so based on the stocks of a company, so the beta is basically going to be working as a kind of measurement to check that what is the loss or what is the profit of that company. All right, now again, as usual, I'm not going into very deep because as usual this is not going to be a webinar based on the finance. This is something which I'm giving you knowledge so that you can have at least a very basic knowledge that what are the terms which are basically used in the finance department in the IT industry. Now if you actually want to know more, if you want to go deep inside of all these topics, then that is something which is a different case. You should be studying about CA, you should be studying about more and more financial we can say things. But again, if you are just in the field of IT but still having a knowledge or having at least some of the basic knowledge of all these finance things is a really good thing to consider, right? So now again, cost of debt. So as usual, we are having cost of equity. In the same scenario, we are having cost of debt, which is known or which is denoted by the RD. Now the credit rating is something which you are familiar, you might be familiar with, that every company is going to be having some credit, right? So if a company is having, you can just understand it kind of like a stars. It's out of like 4.5, what is the rating of a company. So the credit rating is similarly same how telling us the company's credit worthiness, which influences its borrowing cost. So as usual, if you want to purchase the shares of a company, you might be checking the credit rating of that company, right? So the market interest rate, so as usual, based on the market interest rates, you are going to be working, right? So you are going to be lending some money, you are going to be borrowing up some money, and based on the current market interest, you are going to be paying the interest if you borrow the money from that company. So the debt maturity is something, again, as usual, the maturity is completed, your debt is going to be something which is going to be covered on, and you have to return the money without any kind of interest. Now again, if you are going into all these different concepts, so you are going to be familiar with the simple interest, compounding interest, complex interest. So you are going to be working with all these different kind of financial terms, right? So in the school time, if you remember, you might have studied about simple interest and compound interest, or we also known as the maturity or the principal, we say, right? So the ultimately whatever you have lended the money, you return the money, is known as the principal amount. So again, you might need to understand all these different kind of concepts if you're working in a finance department, especially in the field of a company or an IT industry. Alright, so let's proceed forward, and at the very last, you are going to be having some corporate tax rate, which is being denoted by TC. Now, the corporate tax rate is the percentage of a company's taxable income that is paid to the government in taxes. It can affect the cost of debt by reducing the after-tax cost of borrowing. So the tax rate is basically impact on cost of debt. Higher tax rate means lower after-tax cost of debt. Lower tax rate means higher after-tax cost of debt. So overall, the meaning of this thing is that suppose if you lend a money and you are going to run your own company, you just lend a money, right? It can be in the form of bonds, it can be in the form of loans, which we have discussed recently. So the corporate tax rate is going to be having an impact on the cost of debt. So the more debt you are going to be having, the more interest you need to pay. So if you are going to be having higher tax rate, so that means in the later on, in the later of your payments, your tax is going to be lower. But again, if it's in the starting, it's going to be lower tax rates. So in the future, you have to pay higher interest rate based on the tax, right? So interest is going to be again implemented on the tax also. So again, the things are kind of like similar, having some similarity and relationships with each other. And at the very last, you are going to be having a CAP-M model. So CAP-M is a financial model that helps determine the expected return on an investment, taking into account the risk-free rate, market risk premium, and beta. So risk-free rate we do have discussed, market risk MRP we have discussed, and the beta we have discussed. So CAP-M is actually kind of like a model in the financial field in which you are going to be having all the things equally balanced. That means you are not going to be bearing loss, you are going to be making some kind of profit, or if no profit, then you are not going to be making any loss or as well. So CAPM is kind of like a model which works in the field of the finance, right? Now again, as usual, we are going to be having some questions, but as usual, you might need to know some of the formulas, right? So as usual, you can see that I'm having my very first question. A company has the following financial information: market value of equity, which is denoted by E, right? We are having some market value of debt, which is denoted by D, and so on, right? So we are going to be having some numerical questions we are going to be working on, and at the very last we are going to be asked about calculating the WACC of that company. So first of all, we will check for WACC formula here. So if I'm going to be checking here, so you can see that this is kind of like a complex formula, but this is something which is easy to understand, right? So WACC is E by V, and RE plus we can see D, which is debt, V is volatility, RD, and 1 minus TC. So let me write the formula for you here. So we are going to be doing the very first question here. All right, so let's try to do this question. So first of all, let's try to write the formula. So the WACC formula is going to be, as usual, we checked E by E plus D, right, and into RE. So after that, we are going to be having plus, we are going to be having debt, E plus D, into RD. So after that, so there was below 1 minus TC, so we can just put it above 1 minus TC. Now TC, if you remember, so this is corporate tax, right? So we do have discussed all these things, and this is basically the formula of the WACC, right? And every value has been given. This is E, so here as you can see that E is basically the market value, D is basically the market value of debt, cost of equity is RE, cost of debt is RD, corporate tax return is TC, and I think so you can just place up the values. So let's try to place up the values here. So we have to check the values. So first of all, we are having $500,000, so we can simply write 500,000 here. E plus D is going to be that is 700,000. So let's try to make the things easy, right? 700,000 is going to be first. After that, we are going to be having D. So again, D is 200,000, which we do have calculated. E plus D, again, it's going to be 700,000, right? Into RD is going to be 5%. Now again, 5% is not going to be written directly, it should be written in the form of decimal. It's going to be 0.05, which is 5%, right? And 1 minus TC. So 1 minus TC is going to be 30%. So 30% is going to be written in decimal, so 0.30 is going to be something which we have to do, right? So I think so everything is working fine. Now basically we can just calculate all the things. So what we can do is, let's try to do this. So it's common, so let's take 700,000. Sorry, it should be not this one. All right, so let's try to expand this. So 500,000 divided by 700,000. Of course, it is a form of percentage. So we have to, I forgot to do this, right? So I didn't did this. So it should be into, so what was RE? So RE is 10%. So it should be 0.10. I forgot to do this, right? So we have to do 0.10, right? So this is going to be our first section, and after that, as usual, it's going to be same. So let's solve up this also. So it's going to be 200,000, 700,000, and as usual, it's going to be 0.05 into 1 minus 0.30. So it's going to be how much? 0.70, right? So this is the ultimately thing we need to solve, and after that we are going to be having our WACC of a company. So what we can do is we need to calculate this one. So let's do this gone, this gone. Similarly, this gone. So ultimately 5 by 7 into 0.10, we can take 10. So it's going to be around how much? So almost it's going to be 0.7, right? So we can say 0.7, yep. And 0.10, let's take into decimal only. So after that plus, so this is also going to be around cancel out. So it's going to be 0. Around 3, we can say, or 0.2 ultimately we can say, and into 0.035 we can simply multiply. It's going to be 0.07. So plus, it's going to be 0.01, and ultimately the answer is going to be 0.08, right? I'm not sure, but still you can use the calculator, but I think so this is going to be the approximately value. So again, it's coming for 0.08. So overall the answer is going to be 8%, right? So the WACC of this company is going to be 8%. All right, so this is kind of like a formula based question. So the formula of WACC is this: E upon E plus D into RE plus D upon E plus D RD into 1 minus TC. So the question is simple. So a company has the following financial information. You have to find the WACC, right? I hope so that it was not very difficult, but it was kind of like okay. All right. So the first question answer is kind of like going to be 8%, we can say WACC. Now let's go with the second question. A firm has the following data: market value of equity, again E is going to be 800,000, debt is D, C, this is going to be RE, RD, and I think so now you can do also, right? So this is basically E, this is D, this is RE, this is RD, and this is TC. So again, you have to put all the values, and ultimately your answer can be taken out. So again, the formula is really important. So if you don't know the formula, it's hard. Now the question number 3 is kind of different. It is asking for return on investment, right? So an investor purchases a property of this much money. After a year, the property is sold for 250,000. So calculate the ROI. Now if you understand it, it's really easy, right? So how much profit, how much return on investment has been made? So the investment was 200,000. The person made a profit of 50,000. So what is going to be the ROI? So it is not very hard, right? It is not very hard. So we can say the person actually make a profit of 50,000. But what is return on investment? Now this is a profit of 50,000. So for this, we can basically try to use things. So initially, person used 200,000. Sorry, right? And the person makes 250,000. So this is basically the question: what is the ROI? So ROI should be in percentage form, not in the form of numbers, right? So what we can do is, so the formula of ROI is basically the net profit. So net profit is going to be divided by cost of investment, so which is also known as COI. So cost of investment, and simply we have to multiply this by 100. Simple, right? So net profit. So first of all, what is the net profit? So as usual, the profit which the person made, right? So the net profit is basically selling price, what we can do with the cost of investment. So this is actually the net profit, right? So here the net profit is directly, we can say that it's 50,000. So the selling price is 250,000, cost of investment was 200,000. So the net profit is basically 50,000. So simply we can implement this into the formula here. So it's going to be 50,000. Cost of investment, once again, it was 200,000, right? And into 100. So cancel out, cancel out, cancel, 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 cancel. So again, it's going to be how much? So it's going to be 50 by 2, almost 25%, right? So this is basically the answer. So return on investment is 25%. Simple. All right. So I hope so that now if you go to the question number 4, let's read this. A company invest, this is cost of investment, in a new project and expects to generate 140,000. Now this is expectation. They hadn't, we can say, generated. In revenue, the operational costs are estimated 20,000. Calculate the ROI. Now the question is different. Previously we were having a directly answer, but in this the expectations are given and the ROI is basically being asked. So now let's try to do this. So the answer for this question is 25%. So 100,000, 140 revenue, 20,000. All right. So we are having three numerical values. So 100,000, 400,000, 400, right? It was 400, and we were having 20,000. This is operational cost. All right. So not 400,000, 140,000. Sorry. So here it should be not 400, it's 140,000. All right, so now let's try what is going to be the ROI. So if you remember the formula of ROI, which was basically net profit, which is NP, cost of investment, COI, into 100. Now this is the formula of ROI. Net profit formula was basically selling price minus COI, right? So selling price minus cost of investment. Now this, once we find this value, we can replace this value here and we can basically go and proceed with the ROI. But in this case, we are not having the fixed values. We are basically expected to generate, right? So 140,000. So in this case, things are going to be different. We can basically go with one more formula with net profit, which is going to be kind of like revenue. So if you want, you can just note all these formulas down. So revenue minus COI, which is again cost of investment, plus operational cost. Now this formula is going to be used when you are having some operational cost. All right. So simple, not very difficult. Now let's just put up the values. So revenue is expected to have 140,000 minus COI is basically 100,000, which is cost of investment. Operational cost is 20,000. All right. So it's going to be 100, 120, 140. So ultimately this is going to be how much? Almost 20,000, right? So this is going to be almost 20,000. I hope so everything is working really fine. As usual, you can just open up your bracket and the signs are going to be changed, and based on that, so 140 minus 100, 40,000, 40,000 minus 20, 20,000. So this is going to be your net profit. Now simply let's place up the values in the main ROI formula. So 20,000 upon cost of investment is basically 100,000, and ultimately multiply by 100. So 0 0 0 0 0 0 0 0 0 0. So 20. So yeah, ultimately it's going to be 20%. All right. So that's it, nothing very difficult. All right, so the answer of this question is going to be 20%. Okay, so as usual, I told you that these things are really good to understand. If you're coming from IT background, still having some very basic knowledge of the finance is really good one. All right. These actually gives you a practice again in the mathematical things, in the statistical operations, if you're going to be moving forward with those things also. So these things actually gives you a practice. All right. So I always suggest to at least do some mathematics whenever you get time. So again, we are going to be having a question number 5. Spends 50,000. Again, it's asking for ROI. So I'm not going to do the ROI. Now you basically get an idea about the formulas of the ROI. Question 6. A stock has a beta. Now beta, if you remember, it is a company volatile, we can say, option, right? So it's 1.5. The risk-free RF is 3%. The expected market return RM is 8%. Calculate the expected return of the stock using the CAPM formula. Now the CAPM formula is different on how you use the VAC formula. All right. So as usual, I told you that CAPM is a model. So CAPM is a model. Now the formula of this is going to be RE, which is expected return. So RF, so return what we studied, plus beta, and is going to be RM minus RF. Now this is actually the formula which we are going to use. What is the values we are having here? So beta is 1.5, so let's place 1.5. By the way, you should be using in the form of fraction. Okay, so this is in the form of decimal, try to use in the fraction. RF is 3%. Now again 3% is here as usual, so RF is going to be 3%. So instead I can just write 0.03 plus, right? So this is 0.03, this is 0.03 plus 1.5. RM, now what is RM? Market return is 8%. So again 8% is going to be becoming 0.08. RF, which we already write, it's going to be 0.03. So ultimately you can simply plus all these things. It's going to be 0.03 plus this is going to be 1 minus 8, so 0.07. all right, so ultimately you can say that it's going to become 0.10, or in simple it's going to be 10%. So the CAPM is going to be 10% in this particular case, right? So the company is going to be having a CAPM, or the stock is going to be having a CAPM of 10%. So now again the beta of a stock is 0.8, risk-free RF is given, expected market return is given. So what is going to be CAPM? Same formula, you just have to implement the formula, and based on the formulas you are going to be having up your CAPM, VAC, or anything, right? But again the questions can be twisted, right? So suppose a VAC is given in this case. So for an example, a company is having a VAC of this, the we can say, what we can say, the equity is this, the debt is this, what is going to be the cost of equity, which is RE. So the questions can be twisted, right? So it is not very hard. If you know all the concepts and if you know all the formulas, it's going to be easy for you to make all these things work. So I do hope so that you really enjoyed about this finance in IT industry. At least you would be having a very basic knowledge about finance in IT industry. In the next lecture, we are going to be having some more advanced stuff, some more advanced, we can say, terms which we are going to use in the finance department. So if you do have any questions, make sure to send an email to the education diary. Till then, everyone, take care and bye bye.